All right. Well, given the proliferation of negative rates and the renewed interest we're seeing in gold, we thought we'd show you some previously unreleased footage from our interview with best-selling author Jim Rickards. We asked him about the next stages of the currency wars thesis in the context of what he has described as a big science experiment of historically low interest rates. I first asked him if, looking back on his 40 years in the financial industry, whether he thinks this will turn out to be a successful experiment or a failed one. Here's what he had to say.
You know, I do use the word experiment, but it's not my word. It's former Chairman Bernanke's word. I had the opportunity to have a nice chat one-on-one with former Chairman Bernanke recently, and he used the word experiment. He said, this is an experiment. And the way he put it to me, he said, some future Ben Bernanke, meaning not Fed chairman but scholar, it's going to take 20 or 30 years before we know if this worked. Because Bernanke made his reputation as a scholar in the 80s and 90s looking at the Great Depression, which had happened, and the causes of the Great Depression, which had happened, you know, 50 years earlier. And what he said to me was, some scholar 30 years from now is going to look back and figure out if it worked or not. And I didn't, you know, I was polite, but I thought to myself, well, great, Mr. Chairman, we're the guinea pigs. You're the great. You got the lab coat on. This is all an experiment, but we don't even know if it worked or not. And interestingly, some research is coming out now that says QE is very ineffective. That's actually why I don't expect more plain vanilla QE, meaning just buying bonds from the banks and printing the money. That's QE2 and QE3. QE1 was fine. That was an emergency liquidity response to a liquidity crisis. That's what central banks are supposed to do. But QE2 and QE3, those were the real experiments. No one had any idea if they would work. Looks like they didn't work. At least that's what some of the research is saying. And Bernanke agrees with that. He said it'll be a long time before we really know. So welcome to the laboratory.
Oh, welcome to the Twilight Zone. Okay. Well, lastly, I want to ask you about gold, which recently hit a 6-year low, though gold prices are bouncing around. They're starting to edge higher. Should we expect gold to keep falling after a rate hike, or do you think we're seeing the bottom here?
Well, a number of very interesting things going on with gold. The basic analysis is that, you know, people say gold's up, gold's down. What they really mean is the dollar price of gold is up or down. Well, the dollar price of gold, I think of gold as a currency or a form of money. So the dollar price of gold is just inverse to the dollar. So if you have a strong dollar, you're going to have a low dollar price of gold. And if you have a weak dollar, you're going to have a high dollar price of gold. So that's just a cross rate. Like, might as well be euro dollars or yuan dollars or yen dollars or whatever. It's just another cross rate. And go back and look at August 2011. That was the all-time high dollar price of gold, about $1,900. And that same month, literally within weeks, was the all-time low for the dollar in the Fed's broad trade-weighted index. So that was no coincidence. So I'm not surprised to see a low dollar price of gold when you have a strong dollar. I mean, everything's down. So you know, oil, you know, copper, steel, Australian dollars, Japanese yen, I mean, euro, name something that's not down against the dollar. So to me, it's a little bit more of a dollar story than a gold story, number one. Number two, there's clear-cut evidence of manipulation. I talk about this in chapters 9 and 11 of my book, The Death of Money. Don't need to belabor that. But China is in a gold acquisition program looking forward, not happily, but looking ahead, I should say, to the day when the system collapses and you need to reset it. And that's going to be like a poker game. You know, when you sit down at a poker game, you want a big pile of chips. Well, your chips are gold. So China's got to get their gold to GDP ratio up closer to where the United States is. So they've been buying gold by the thousands of tons. Now, if you were out to buy a couple thousand tons of gold, would you want a high price or a low price? Well, of course you'd want a low price because you're a buyer. So China and others are behind this manipulation. So you get the manipulation going on. But there's a third factor, which is right now, and it's a scary chart. I've seen a lot of bubble charts in my career, but if you look at the ratio of paper gold to physical gold, and there's always more paper gold, gold futures, gold options, unallocated gold forwards, gold ETFs. I mean, there's all kinds of what I call paper gold. And it should be larger than the physical. I mean, that's what any futures leverage trading system is all about. But that ratio of paper to physical is at an all-time high, and it has spiked significantly. And I'm starting to get reports from around the world, different correspondents, all credible, all seasoned, who are on the physical side of it, and they say you can't get gold, not in size, So it's, I think we may be heading for a train wreck there where someone's going to fail to deliver some physical that someone demands, and then that could set off a super spike. So you got it's the inverse of the dollar and deflationary vectors. That's keeping the price down. You've got Chinese and other manipulation keeping the price down, but there are these sort of tectonic forces at work that could cause a super spike sooner than later. It's a very unstable situation.